Hello, and welcome to this lecture on the Federal Reserve's discount window. We will discuss how the Federal Reserve uses the discount window to provide a variety of short-term cash loans to banks. We will examine primary, secondary, and seasonal credit. We will see what these loans look like and understand why they exist. We will then draw a connection between the discount window lending and monetary policy. We will understand how the discount rate influences the Federal Reserve target interest rate. Okay, let's get started. Discount lending has long been a tradition in banking. The basic idea is that the lender first calculates the required amount of interest and fees. The lender then discounts this amount from the face value of the loan. The borrower gets the discounted loan today. This loan amount is already reduced upfront to account for interest and fees. But then the borrower must repay the full face amount at maturity. Let's go through a quick example. You want to take out a discount loan with a face value of $100. The maturity of the loan is 1 year. Let's say the lender calculates a discount rate of 10%. This covers the interest on the loan and fees. The loan amount that you receive today is $90. This is the face value of $100 minus the $10 of interest and fees. But in a year, you will have to repay the full $100. Why is this type of loan useful? Well, the cost of a loan is accounted for upfront. This means only one payment is required rather than a series of monthly interest payments. For that reason, discount loans often help with short-term funding needs. Since 1913, the Federal Reserve has offered discount loans to banks. Why does the Fed do this? Well, the loans provide cash to banks on short notice. This ensures that there is enough cash in the banking system. In the extreme, this can prevent bank runs and banking panics. Discount loans were provided at a special window at each of the regional reserve banks called the discount window, hence the name discount window lending. Nowadays, the Fed provides short-term cash loans secured by eligible collateral. These are secured discount loans. However, the term discount window stuck. It is still used when the Federal Reserve lends directly to banks. At the Federal Reserve, banks currently have access to several types of discount window lending. We will focus on primary credit. This is the most important category. The main purpose of primary credit is to provide cash in case other funding is not available. Primary credit discount loans are available to well-capitalized, healthy banks. These are short-term loans with a maximum maturity of 90 days. The interest rate on primary credit loans is set relative to the target federal funds rate. This is usually higher than the interest rate on other forms of short-term credit. This incentivizes banks to borrow in the private cash markets. The Fed should be a last resort. These are secured loans. The Federal Reserve accepts a broad range of collateral, including commercial and industrial loans, consumer loans, residential and commercial real estate loans, and US Treasuries. Some of these types of collateral are riskier than others. To account for risk, the Fed applies margins, indicating how much a bank can borrow against each type of collateral. Here's an example of a margin table. These margins are as a percentage of the market value. A US Treasury with a remaining maturity of 1 year is very safe. A bank can borrow 99 cents on the dollar. In contrast, a loan for commercial real estate with a remaining maturity of 1 year is still rather risky. Banks can only borrow between 35% and 95% of the value of the loan. How is the discount window related to monetary policy? The discount window helps the Federal Reserve to control short-term interest rates in the economy. How does that work? Well, there are two things to keep in mind. First, a discount loan from the Fed or an interbank loan from another bank are close substitutes. Both are short-term loans. Any healthy bank can access either the interbank market or the discount window. Second, recall that the discount rate is set near the upper bound of the federal fund target range. Now, what happens if the realized interest rate on the federal funds exceeds the discount rate? Well, it would be cheaper for a bank to borrow from the discount window. This shift in demand away from the interbank loans will put downward pressure on the federal funds rate. Hence, the discount rate enforces the upper bound of the federal funds target set by the central bank. It ensures the realized federal funds rate does not get too high. We can see this in the data. From 2003 onwards, the primary credit rate always sits above the federal funds rate. Let's sum up. In this session, we have discussed the Federal Reserve's discount window. This is an important part of the traditional monetary policy toolkit. What did we learn? First, discount window loans are short-term secured loans to banks. They help banks manage any short-term cash needs. Second, discount loans are a substitute to borrowing federal funds in the interbank market. As a result, the discount rate provides an upper limit for the federal funds rate.